Accounting Standards AS and IFRS. In the words of Kohler, accounting standards are codes of conduct imposed by customs, laws, or professional bodies for the benefit of public accountants and accountants generally. So, in simple, it means all the rules and regulations or the guidelines to prepare accounting statements that comes under accounting standards. So it is basically rules, regulations, or various type of framework, or we can say norms also. Then accounting standards provide the framework and norms to be followed in accounting so that the financial statements of different enterprises become comparable. Now, how can you compare the financial condition or the financial statements of different organizations? Only if they are using the same framework, same norms, or same rules of accounting. Only then you can compare those different enterprises. So accounting standards will provide the framework and norms that to be followed in accounting. Then need for accounting standards. The first main need is to promote better. So we do this part to find out the profit or loss. So due to this concept, adjustments are made for prepaid expenses, payable expenses, or income received in advance, receivable income, depreciation, bad debts, or any other reserves, etc. So these were the important concepts of accounting. Understanding of financial statements. So this can be done with the help of accounting standards. There will be common accounting standards for all the organizations, for all the situations where finance is required. So with the help of accounting standards, we can understand the financial statements which are useful for any business or even for the government and even for individuals. We can understand it in a better way. Then to help accountants to follow uniform procedures and practices. Uniform means same. So here accountants are the people who make accounts. So with the help of common accounting standards, they can follow the procedures and practice in a uniform, in a same manner. Third is to facilitate meaningful comparison of financial statements of two or more entities. This comparison can be done if the procedures and practices or norms are uniform in nature, means same in nature. Then to enhance reliability of financial statements. Now you require financial statements, those are reliable, those which are trustworthy. So when we follow accounting standards, it will enhance the reliability of the financial statements to meet the legal requirements effectively. Now in India or anywhere in the world, accounting standards are useful for the legal requirement purpose also. So in legally you have to make accounting standards, you have to work as per the accounting standards. Then there is one term here, International Financial Reporting Standards, IFRS. So what is IFRS? Let's see. So IFRS are issued by International Accounting Standard Board, IASB. IFRS is a set of international accounting standards stating how particular type of transactions and each other events should be reported in financial statements. So this works at international level, not at national level. So for international level, we will use IFRS, International Financial Reporting Standards. As per this standards, all the transactions or all the accounting treatments are being recorded. Then IFRS are issued to develop accounting standards that would be acceptable worldwide and to improve financial reporting internationally. Now in the era of globalization, you require a common accounting standards which can be accepted worldwide. So for that purpose, IFRS is used. So IFRS are issued means they were established to develop common accounting standards that anywhere in the world can be acceptable, whether you are staying in India or in USA. those accounting standards are acceptable which are under IFRS. Then accounting standards in India. Now in India, standards of accounting is issued by Institute of Chartered Accountants of India, ICAI. The Council of the Institute of Chartered Accountants of India constituted Accounting Standards Board ASB on 21st April 1977, recognizing the need for accounting standards in India. So here the main objective was to formulate accounting standards after considering various laws or business environment and international accounting standards. Now, out of 31 accounting standards issued by ICAI, we are going to study some of the important accounting standards which are given to you in your textbooks. So let's begin with that part. The first one is given to you here as AS1, disclosure of accounting policies. So what do you mean by this accounting standards? According to this standard, the accounting policies followed in the preparation and presentation of financial statements should form a part of the financial statements and normally be disclosed in one place. So all the information or all the rules, regulations or policy you have adopted while preparing accounts, while preparing financial statement must be disclosed to concerned authority if required. Then accounting standard 2, valuation of inventories. According to this standard, inventories in general should be valued at lower of historical cost and net realizable cost. So this accounting standard prescribes the accounting treatment for inventories and sets the guidelines to determine the value at which the inventories are carried in the financial statements. So we are going to take lower cost, lower of historical cost. Then next is AS3, cash flow statements. According to this standard, a cash flow statement is prepared and presented for the period for which the profit and loss account is prepared. So here all the information about the cash flow into your business has to be recorded for the particular period only. So for the year you prepare profit and loss account, for the same year cash flow statement should be there. Then there is AS6, depreciation accounting. According to this standard, the depreciation amount of an asset should be allocated on a systematic basis for each accounting period during the useful life of an asset. So depreciation means reduction in the value of asset. Now when you use certain asset, what happen? Its value will get decreased accordingly. For example, if you take a mobile phone in the year 2020, the value of that mobile phone is 20,000. Then after 5 years, the value will get decreased of that mobile phone. That reduction in the value is known as depreciation. So here in this accounting standard, it indicates that when you take the amount of depreciation of an asset, it should be done systematically on the basis of for how many months or year or the period you have used that asset, or during the useful life of an asset, that we have to consider while calculating depreciation. Then next is AS8, accounting for research and development for companies. Now see, there some dates are also given to you that we have to remember. Now according to this standard, the amount of research and development cost should be charged as an expense of the period in which they are actually incurred. So your research and development is one of the most important part for any business. Due to research and development, new technologies arises in the business or in the business environment. So such cost of R&D, means research and development, should be expressed or should be charged as an expenses for that particular period in which they were actually incurred. Like all the expenses of research and payment of 2020 or 2021 should be charged in that period only. Then AS9, revenue recognition. This standard deals with the basis required for recognition of revenue items in profit and loss account of an enterprise. It lays down conditions to recognize revenues that arise from the various transactions of an enterprise. So what we can term as revenue, all the rules and regulations regarding it are stated in accounting standard 9. So what will be the revenue for the business, what will be income, revenue, both are different. So which terms or which items we will recognize as revenue, that comes under this accounting standard. Then next, AS10, accounting for fixed assets. So according to this condition, the cost of fixed assets should comprise of the original cost, means the cost of the asset when you purchase it, and any attributable cost, means any additional cost of bringing the asset to its working conditions for its intended use. For example, if you purchase one air conditioner, the value of the air conditioner is say rupees 50,000, but the installation charges are 5,000. So now 50,000 plus 5,000 will become 55,000. So the entire cost of that air conditioner will be now 55,000. So this comes under AS10. There is one more thing here, that the fixed assets should not be shown in financial statement on their disposal or when no further benefit is expected from their use. Then AS12, accounting for government grants. According to this standard, government grants should be recognized when there is an assurance that the enterprise will comply with the conditions attached to them. So this standard deals with the accounting for government grants. Such grants are offered by the government agency or any local, national or international bodies. These government grants are sometimes referred to as subsidies, cash incentives, etc. So when government provide all these benefits to the businesses, then even those business needs to comply with the various conditions attached, means various terms attached to it. Then accounting standard 13, accounting for investments. According to this standard, an enterprise should disclose the current and long-term investment distinction in its financial statements. Here, current investment are those investments which by their nature are readily realizable or are intended to be held for less than a year from the date when such investment is done. And long-term investments are those investments which are not current, even though they might be freely marketable. So such investments are done for the longer period of time. Now current investment should be carried in the financial statements at the lower cost or fair value. Long-term investment should always be carried in financial statements as per their cost price. Then accounting standard 22, accounting for taxes on income. According to this standard, tax expenses for the period comprising current tax and deferred tax should be included in the determination of the net profit or loss for the period. So this accounting standard is used to find out or to match the differences between accounting income and taxable income. Then accounting income is the net profit before tax for a period as reported in profit and loss statement. Thank you so much.